morning. We're live.
Good morning. Good morning.
How you doing, man?
Good. I'm doing well. Yourself?
Doing awesome, man. It's Father's Day weekend. We're going to be talking about budgeting today. We've brought along our office's financial capacity assessment to share with you guys, give you a little bit of a insight into how to manage your money better, because a lot of people are never taught this. I heard that they're starting to incorporate this sort of stuff in school now. Have you been able to confirm that?
I have not heard, nor I can't confirm nor deny that statement. I don't know, but it's about time if they are. Seriously, it's about time.
Well, I mean, if you leave it in the school system and government's hands to teach people stuff like budgeting, it's not going to be all-encompassing and complete, but at least it's a start. So we'll give you guys what we have. This is a form that we've used close to 20 years now. I think I created this form back in 2003 or 4, and we've updated it kind of over time. So it's evolved a little bit, but this is the bread and butter of what you need to understand for budgeting. So this is Budgeting 101. Grab a pen and a piece of paper, and well, let's get started. I'll just throw it up on the screen. Add to stream. And let me try to reformat this so it takes a little more real estate and is a little clearer. How's that look on your end?
Yeah, it looks fine from where I am.
A little bit bigger. There we go.
Yeah, that's good. That's good.
All right. So before we get started and go through the tables, I'm going to just kind of go above the fold and below the fold so you can pause your screen if you want to copy our form. We don't have a downloadable form, but if you want to rip it off and create your own. What did you use to make this? Was this a Excel document or a Word document?
It was an Excel document we used to do the template, and then we just print it as a PDF copy, so it becomes a nice clean copy without any lines in it other than the ones we've created. But that's the original template is Excel.
Okay, so let's just go full screen on it. So you guys can pause the video here and just jot down what you need to know. So the top area is monthly income. Below that, you're going to have your expenses, which is all-encompassing, every expense that you have, every major expense. So we would probably suggest everything. I mean, if you want to go completely micro to every penny that you spend, go nuts. But as a bare minimum, if you're spending more than $10 or $20 a month on something, it should show up in a monthly expense column. So if there's something that needs to go in there that isn't in our main form, we always expand when we have our consults with our customers and add to what they fill out to make corrections. But you get the idea, right? So you've on the top section, you've got income, expenses, and then you've got your assets and liabilities, which you should also be managing as well. And if you want to figure out your net worth, let me just slide it up a little bit more so you can pause it right about there. And if you want to figure out your net worth, it's just assets minus liabilities. It's straightforward, okay? If you want to figure out your cash flow, it's your monthly income minus your expenses. And you may have other income sources depending on where you are in life. These are the main ones, of course, that we deal with. You could add other things in there like alimony. You could add things in there like child support. You get rental income. There's all kinds of things that you could add in there, but these are the main ones that we generally work with. So let's go back to where's your screen? There we go, that one. So walk people through what we're looking at here and why this is important. So let's talk about the income section first. So walk people through that if you can.
Yeah, the income section is generally the quickest and the fastest and the simplest to complete. Most of our clients are married couples, most. So essentially you just ask them for the primary's income and the secondaries, which is generally the spouse's income, and that's after taxes. So that's after their take home, that's their cleared income known as net income. And so we have the two boxes for the spouse, sorry, one box for the spouse, one box for the primary. And then the third box below it, which is listed under other income. And then in brackets, it says child tax credits and universal benefits. That's where we put any other income source. So as you indicated, there could be alimony, there could be child support, there can be child tax benefits, there can be rental income, there can be residual income from investments, there can be pension income, there can be disability income. So there's all different types of incomes, but we put it in that box there. And then under it is your total household income. So you just total all three of them up together, all three boxes, and that's your household total income. It's a simplified procedure for that one. It shouldn't take long, more than a minute or two to get all the income sources for that. and you list them. The next column or the next section is your expenses. And this is what we've touched on quite a few times in previous videos, is essentially, this is what you would call your bread and butter. This is what you really need to get to the bottom of. You need to determine what your expenses are. And I highly recommend you cross-reference this section with bank statements and or credit card statements. That way you can see what you're actually spending on each one of these areas. Now, there are some areas on the form that are missing that you might actually have in your budget. For an example, security system. If you're paying $40 for a security system, you're not going to see it on the form here. But if you're cross-referencing your bank account statement and or your credit card statement, you will see you're paying $40 a month for your security system, and then you can add it to the form in one of the areas that you might not be using. So if you've got no public transportation costs, it's the second last item from the bottom on the left. You can just cross that off and you can put security in there, and then you can put in the box next to it the $40, and that's how you can account for that expense. So it's a simple process as far as we're concerned. You just cross-reference your bank statement or your credit card statement, your rent payment, your mortgage payment, whatever it happens to be, you list them one by one. And then at the end of that section, under the total expense section, you put what the total expenses are. You add them up. You use your phone as a calculator, or you get out an old school calculator and you type in all the numbers, and there's your total expenses. The two biggest expenses on this form, generally speaking, is your rent or your mortgage payment, your car loan or your car lease payment, and if you've got children, childcare payment. So what you want to do is you want to try to keep your expenses as low as possible, so that way you can maximize your cash flow and stay out of debt and invest into investments of some sort. So my personal opinion is that your rent or your mortgage payment shouldn't be any more than, personally, I don't think you should be paying more than 25 to 30% of your income should be going to your mortgage or your rent. And for your car payment, I don't believe anything more than 15 to 20% should be going to your car loan or your car payment, loan or lease. So if you're talking a $3,000 income as the individual, if it's a single individual and it's a $3,000 income that this individual makes, I wouldn't think that $1,000 should be any higher than for your rent or your mortgage payment on that example. And for a car payment, it shouldn't be any more than $400 in that example. That's about 15% for the car loan, and that'll be about 33% for the mortgage payment or your rent payment. And that will give you some flexibility in your budget for all the other expenses that you've got, groceries, utilities, telecommunications, as well as some buffer for the rainy day fund, which is a savings fund, and or investments.
Right. So let me just chime in here. We've got, let me make this a little bit smaller. So you got your income sources and your expenses. Cash flow is calculated by taking income, subtracting your expenses. So debt is a math problem. If you have accumulated debt, it's because you haven't managed these two items, income and expenses. If your income, we'll just use an easy number like $1,000 a month. So if your income's $1,000 a month and you're spending over $1,000 a month, you're going to wind up in debt. You should, I mean, ideally, if you're following savings protocols, you've read books like Rich Dad, Poor Dad and stuff like that. Listen to Warren Buffett and guys like that. You will tend to save your money first, then spend. But that's not widely accepted by the public today. So if you want to get into that stuff, go read those books, go study excellence, go learn how the wealthy have accumulated wealth. But start by not being in debt. Start by having a positive cash flow. Okay. Start by having money left over at the end of the month, not month left over at the end of the money. A lot of people run out of money by 3/4 of the way through the month, and there's still a month left over. So they have to use their credit cards. Sometimes they borrow against credit cards. They use cash advances. Those are incredibly expensive. Some people borrow against their future paychecks. So cash payday loans, for example, those were and still are incredibly popular. But if you want to stay out of debt, it's as simple as understanding basic math. Make sure your income is more than your expenses and you have money left over. And what you should be doing with that money left over is investing it and stashing it away into a rainy day fund. And you will never have a problem with credit card debt. So if you lose your job, if you have to move, if you have an unplanned pregnancy and your wife's out of work for a period of time, you'll have money set aside. You'll have a rainy day fund. The bigger the fund is, the better. Some people say, well, how big does a fund need to be, Rich? Like how many months savings, do I have to live off to, set aside? The more, the better. If you've got 5 years of income, monthly income set aside so that you don't have to work for 5 years if something happens and you have to deal with that, that's good. That's better than 5 weeks. It's better than 5 months. Have as much as possible. As a general rule, most financial planners say somewhere between 3 to 6 months. I've heard as many as 9 months. You decide what's important to you, okay? We're not here to police that. We're just here to dispense advice. You can decide what it is that you want to do with it. So consider those components added on to what Andrew just talked about there. Do we cover everything that we need to for this income versus expenses part?
Yeah, like I said, the most important factor here is, like I said at the beginning, is you got to cross-reference these numbers with your bank statement or your credit card statement. If you're not cross-referencing, you're just guessing. And then guessing is not a good indication of what's actually happening. You really need to know what's happening. You need to cross-reference that information with your bank statement and your credit card statements.
Let me ask you this question before we move on. So out of all these monthly expenses that you see, because I mean, you deal with these on a frequent basis, obviously. What are the top 3 or 4 within this list that people either abuse or don't take seriously, where they should be tightening their budget, and they can easily tighten their budget? Like, it's not going to ruin their day, obviously, to make some changes.
The 2 biggest ones that I can see the most room for improvement is telecommunication expenses. So home phone, telephone, cell phone, internet, cable packages, Netflix packages, all those types of streaming packages. Mm-hmm. I've seen individuals with prices close to $500 to $1,000. The parents will take care of the children's cell phone bills. If there's children, anywhere between 8 these days and 13 or 14, even upwards of 15, the parents are covering the cell phone plan, and it's almost $100 per child for that. So that's one of the biggest rooms for improvement. And the other room for improvement is really car loans or car leases. Some people go out and finance extremely expensive cars, $1,000 per month. They really don't have the ability to sustain that on a long term. They should be returning that vehicle and leasing or financing a much more affordable vehicle. So rather than $1,000, it's pretty common to go get yourself a car payment, which is around the $500 mark, and that will free up quite a substantial amount of money. So those are the 2 biggest areas for improvement.
All right. And let's go to assets and liabilities and why this is important. So this isn't, specifically tied into budgeting to make sure that you're not in debt, but this is an indicator of your net worth. So you want to talk about assets and liabilities?
Yeah. So in our line of work, this is important for what we do, because when we're negotiating with creditors, they essentially need to know, and they want to know, what type of assets the individual has. And the more assets they have, with the less encumbered loans secured to that. So for example, a house with a large mortgage would mean that there's very little equity in the house. If the house has got no mortgage, there's a ton of equity in the house, and creditors frown upon that. So this section is important to us in what we do day to day. It's not so important to an individual looking to go over their budgeting situation. However, it's still relevant and it's still helpful. So there's a section for house. Now, obviously, it doesn't have to be a house per se. It can be a condo, it can be a townhome, it can be a cottage, it can be a mobile home, it can be whatever it is. But essentially, your home is your house. So you can list your asset value next to the property. Vehicles 1 and 2, we've listed them as 1 and 2 because most of our clients are married couples, and therefore they each have a vehicle. So we've listed it that way. If you've got more than 2 vehicles, you can just list next to them the value. So below it, there's a little bit of an empty space below vehicle 2. You can put vehicle 3 if you've got vehicle 3 and put it in there. We've got sections for cottages. So that can be, cottage, camper, trailer, whatever it happens to be in terms of a secondary property that you go to visit in the summer or in the winter. And then your last box for the assets is savings/other. That can be investments, savings accounts, GIC accounts, RRSP accounts. If you want to list there your children's sorry, now I'm trying to forget what that is now. What's the children's investment fund, Richard? The
one for school, RESP, I think.
RESP, yeah. So the RESP, you can list that in there as well. But essentially, that's where you can put your assets. And then at the bottom of that section, there's total assets. It's in bold. And then you just get your calculator out, you add them all up, and that's your total value of your assets. Now, so in terms of your assets, you don't really need to list anything in the residence. So you don't need to list your furniture, your electronics, your clothing, your jewelry. because generally speaking, that stuff is not worth so much on the secondhand market. If you're going to sell a TV on the secondhand market, you might get a couple $100 for it. So there's no reason to list it on the financial form here.
Do you ever talk to people that need to list, like, disclose to you things like gold bars or Bitcoin or anything like that, or you don't come across that?
Gold bars, no. Bitcoin or crypto is now more relevant because it's becoming more popular. Mm-hmm. So we do have to ask about the investment side of things. And when we ask about investments, we also say any cryptocurrencies. But essentially, you just want to list what you've got there. Nothing in the residence, unless you've got a ton of jewelry. And it's not common for our clients to have, that type of asset with a ton of jewelry. But if someone's sitting with pearl necklaces and ton of diamonds in their jewelry box or their jewelry safe or whatever it might be, then you would want to list that on your own financial form here. But if it's just typical everyday household items, electronics, furniture, and just a general jewelry, there's no point of listing on this form. It's just the major assets, vehicles, toys. You can put trailers on there. Some people have trailers to move around, boats or ATVs or Sea-Doos or snowmobiles or whatever it happens to be. You can put those on there on the financial form under your assets, because those actually do retain some value. But like I said, household items, there's no point. And then moving down to the liability section. So this is your essentially your liabilities that you might have secured towards those assets. So mortgage payments is secured to your property. Car loan or car lease payments are secured to your vehicle. Student loans we've listed on here for those that are younger that are still indebted to the government or the bank for student loans. And then taxes are on here as well. So that will be either property taxes if you're a homeowner, business taxes, and or income taxes if you owe Canada Revenue Agency money on that. And then the very last box we have under the liabilities is unsecured debts. So those are the credit cards, lines of credit, loans, store charge cards, overdrafts, payday advances, all that type of unsecured debt you would put into that box there. And that's not your monthly payment you put in there. That's your total debt, what you owe on the balance of the product. So if you're carrying a $10,000 credit card and a $10,000 line of credit that are both unsecured, you would put $20,000 in that box, not the monthly minimum payment that you're paying, which might be around the $400 mark. So once you've put in all your numbers, you can then get your phone or your calculator out, you add them all together, and then you subtract your liabilities from your assets, and that would give you your net worth. And that gives you an idea of what you are worth if you were to sell all your assets and then take care of all your liabilities, which is the term net worth.
Okay, well, there you have it. It's pretty straightforward. I don't have anything to add here. Come on. I don't have too much to add here on this. Why is this warning popping up? Hang on, I got to remove and add back to the screen. Let's see what happens here. Reload site. Oh, okay. Anyway, I don't have much else to add to that that Andrew gave you. Those are the basics. Okay. Just out of curiosity, what percentage of people that you talk to are able to fully disclose and understand all their income, expenses, assets, and liabilities without any kind of assistance, from you?
I'd say maybe around 40 to 50% of the people.
And then the other half, or more than half, it sounds like, need you to kind of dive through everything. I mean, plus you look at the credit reports, you look at the statements. So there's stuff that pops up that they either forget about or they may not have considered because they haven't addressed it in months. Yeah,
there's a lot of things in their budget that they leave off. Some of it might be accidentally, some of it might be consciously. They just don't want to disclose. And the biggest one is family assistance. When someone's helping out a relative financially, they just don't want you to know.
When you say family assistance, you mean like sending money overseas to family, like back home, right?
Yeah, that or assisting a elderly parent with their living expenses. So if they're living in the same country, let's just say they're in Toronto and their parent lives in Toronto, but their parents are living on a really low income, pension income. We have some individuals that assist with the care, the residence that they're living in, and they just don't disclose it. And they disclose it much later down the program when we're looking at their budget. We're thinking, hold on, something's not adding up here. We're seeing a discrepancy that we can't account for, and it's pretty substantial, $400, $500, $800. And it comes to our attention that, they're sending money home, or that they're helping out a relative because the relative lost their job, or the relative is elderly and they're on a very low pension. So that's the biggest thing that they generally forget about or leave off, is the embarrassment factor of helping out a relative.
Yeah, and you got to be careful with that. Like a lot of people come from cultural or religious, narratives where it's hardwired into their beliefs that they have to take care of other people that are family members in other countries. And as a result of that, they can rack up a ton of credit card debt and other financial obligations, and ruin their own lives. I mean, you have to like have your own house in order before you try to help other people. I don't I can't emphasize this enough. If you're racking up debt to take care of other people, you're the problem. Okay. The problem is not the financial system. It's not anything else. It's your ability to budget and manage your money. You're either not making enough money or you're spending way too much money. And that's how you end up in debt. So take a look at the guy in the mirror when you get up in the morning and hold that person accountable, not others, before you start getting upset about what we're talking about here. Because it's really, really, really important that you guys understand the basic mathematical function of income minus expenses equals your cash flow. And you should have a positive cash flow every month, which brings you into the second quadrant, which is essentially assets minus liabilities. And the older you get, you should have more assets than liabilities. Ideally, as you move into the autumn years of your life, you should be completely debt-free with no liabilities whatsoever and a big pot of gold at the end of the rainbow, which you're able to use for, retirement years and everything that comes with that. The vast majority of healthcare spending that people need to deal with is, I think, spent, in the last 10 years of their lives. So there's going to be things that are going to pop up that are going to require attention. And you can solve a lot of those problems if you've planned for it in your life by being responsible with your budget and not blowing it on silly things and having a negative cash flow every single month, racking up debt. It's simple, but it's not easy. Math is simple, but it's not always easy to execute because we get a lot of narratives hitting us all the time with advertisers and marketers and credit card companies telling you that you've got way more money than you think. And, sign here, just take advantage of this promotional insert, whatever offer it is. There's no free lunch. There's work that's involved. So make sure that you're on your budget. Would you recommend budgeting monthly? Like, do you budget for yourself monthly? Do you track all of this monthly? Or because for me, it's a monthly exercise still.
Yeah, you said that on a previous video that you do it monthly. I don't do that frequently. I will do it no less frequent than every 6 months, but it's generally every 3 or 4. Mm-hmm. I'll go over the income. I'll go over my expenses. I'll look at what I have in cash flow surplus that will allow me to determine what kind of investments I can be putting into. So I do mine no less than every 6 months. Semi-annually is my minimum.
All right. So keep an eye open on that. You should definitely be, if you've got the cash flow stuff sorted out and you're definitely positive, once a month, like at the start of the month is when I do it. On the first of the month, I take a look at my assets minus my liabilities, which will then bring me my net worth. And I'm managing that on a monthly basis. You can't manage something that you're not measuring regularly. It's as simple as that. So be diligent with it. Now, that being said, I think we'll start to wrap up. You got any closing comments for guys?
No, if you want to put the ticker on the bottom of the screen, we can talk to that. So
ticker's up. Go ahead.
There you go. So essentially, guys, if you live in Canada and you've got Canadian debt, you don't actually necessarily have to live in Canada. But if you're an expat or if you have Canadian debt, we can help you out. You have to have $15,000 or more of unsecured. That's obviously credit cards, lines of credit, loans, overdraft, store charge cards, stuff like that. Go to our website, www.totaldebtfreedom.ca. Schedule in a consultation with one of our debt consultants and book a call. We will give you a call at that time you've booked so we can discuss your situation and give you a free consultation. Those consultations can range between 15 to 25 minutes for the first time to see what your best course of action is. If it's not our program, we will recommend and suggest that you go elsewhere, such as a bankruptcy trustee, if that's the best route for you. And that's all, everyone. I hope you guys have a great Father's Day weekend, and same to yourself, Rich.
All right, guys. We'll see you next Saturday morning, 9 a.m. Eastern Standard Time. Enjoy the weekend. Give your old man a hug.
Yeah, take care.